Joining us now, we've got Michael Underhill, Chief Investment Officer, Capital Innovations, with insight and perspective on how the market is performing recently. All right, Michael, I wanted to start out with a conversation about this 9-day winning streak that we've seen in the S&P 500. Looks like we'll have a little bit of pushback on it today, or at least based on the pre-market action. What's your take on where we are, especially given now with historic performance in a different kind of way? You know, this is the longest winning streak in more than 20 years.
Yeah, I think when you look at the fundamentals, they're showing things are intact under the surface. And when you look at these types of highs and the fact that we've had such momentum in such a short period of time, it's establishing fundamentals, but also strong technical patterns. And so something like this doesn't happen in a bear market. Fairly bullish across multiple sectors, providing some meaningful support.
Okay, and then you said that you've been investing aggressively during this recent bounce. What gives you confidence that this is sustainable?
Yeah, I think when you look at some of the sectors we're investing in, think about independent power producers. Artificial intelligence is consuming 3% of all U.S. power generation today. By 2030, it's going to be closer to 25, almost 26%. And so in a world in which we need more electricity and more power, stocks like these, the independent power producer sector in particular, that corrected anywhere from 20 to 30% in that April swoon. And we were stepping in and picking up shares that admittedly are benefiting from a transitory pickup in the market.
And then speaking of that, so the transitory word, I'm curious to know about how you reconcile the recent strength that we've seen, including that jobs report that was better than expected. But then there's been some expectation that we'll see some more deterioration in the next jobs report in May. We did get, the data showing that GDP did contract recently. You also have this ongoing still policy risk because we don't have trade deals yet. How do you reconcile that?
I think the best analog for this is if you look at what happened in Argentina under Javier Milei. He basically cut the deficit, cut government employees, right? He made foreign direct investment offers to many corporations, private sector capital corporations. They came in and conducted hundreds of billions of dollars of foreign direct investment. Argentina went into a transitory 6-month recession and came out the other side with lower rates, lower inflation, lower deficit, and a better fundamental economy. That's one of the best analogs, I would say, when you look at what's going on just from a top-down policy perspective, as well as the fundamental bottom-up GDP, economics, jobs. We're going to have a transitory, for lack of a better phrase, recession. And we come out the other side with over $4 trillion of foreign direct investment. So think private sector capital investment, things, Taiwan Semiconductor over $100 billion, Nissan over $20 billion. You have multiple corporations that are creating jobs, establishing newer and expanded manufacturing and distribution. That's going to create additional jobs, tax and revenue benefits, wage inflation, and more stability with the onshoring or think reshoring within the United States economy. To get there, it doesn't happen in days or weeks. It takes a period of months, so we'll see it hit by third to fourth quarter.
Okay, and then I'm curious to know your expectations for the Fed this week. When I look at the CME Fed Watch tool, it looks like there's not an expectation of any change to the direction of interest rates. But then there's this, growing concern that the Fed might end up being too late. What's your view?
I think the Fed's been, admittedly, they've been off balance a couple times. I look at where we are, strong jobs report last week. Underneath, the economy's not signaling anything that leads you to believe that there needs to be a rate cut, i.e. Powell's looking at multiple metrics, inflation, jobs, energy, things like that. There are things percolating under the surface. Is that an impetus for a short term, a cut in rates? Not today. But he'll continue to evaluate it. He has a firm hand on the tiller, and I think he's looking at multiple metrics, quantifiable metrics, to give him a better indication as to the direction of rates.
Okay. I'm looking at a chart from you, Michael, where you were allocating, you said 30% to alts. What is the basis on that, and how do you, what alts do you like?
Yeah, I think when you look at the marketplace, the 60-40 model is effectively dead. We saw that warnings shot over the bow in 2022, with equities, large cap equities and investment grade fixed both roll over, fail to perform in 1 year. We've seen a surge in equities, and then you've seen bonds getting a bid, trying to get a bid in 2025. But I think what you're seeing is the wealth management channel is trying to emulate more of the institutional investor channel, where they're allocating up to 30% to alternatives. And they're dividing that amongst 4 food groups: private equity, private credit, private infrastructure, and private real estate, where you can dial up and dial down your exposures in an effort to generate both growth and income that's uncorrelated to the large cap equity markets or even investment grade fixed markets. And again, in the inflation protected income within things like infrastructure and energy, as well as things like private credit, are complementary to an existing asset allocation portfolio and not going to correlate to large cap equities or investment grade fixed.
Okay, great insight. That's Michael Underhill, Chief Investment Officer, Capital Innovations, joining us with his big picture take on the recent trends we've seen in the market, where he sees it going. Appreciate your time. Thank you, Michael.